I welcome you to this lecture. My name is Wilber Ssebuyungo Kivekayunga, a lecturer at Nkumba University and the Managing Director of the Action Entrepreneurs. In this tutorial, we're going to focus on managerial economics. And specifically, in our managerial economics, we are going to unearth the economics in a business, and later on we shall progress. So economics is very relative to business, and actually businesses contribute to what an economy possesses, and therefore you cannot build an economy without building businesses. The businesses within which the economy is thus are significant contributors to what an economy would have to reflect. Therefore, if one is to build an economy, we'll have to definitely build the businesses in that economy. So an economy cannot grow beyond the growth of the businesses in that economy. Because what the economy has is actually a summation of what businesses have. So in countries that develop their economy, they widely focus on how to develop individual businesses and creating an enabling environment for such businesses to progress and develop. So the profit and loss statement of the business should actually be indicating that these businesses are making profits, or if they are making losses, there should be projections indicating that there will be a growth from loss making into profitability. If such projections are not realized, and either the government or the leadership within which these businesses are thriving has not created incentives to enable these businesses operate out of losses and get to profitability, then these businesses are likely to wind up businesses, operations, and growth. So when businesses are enabled and they are making profits, and the other side of their balance sheets are growing in increasing assets and decreasing liabilities, then we see that the business will have more equity and it will have more net assets to operate. So if businesses are not increasing and growing in their balance sheet or a statement of business position, which we call the comprehensive statement of business position, called the balance sheet, that indicates an increase that should indicate for a health business an increase in the net asset base, then that business is likely to be swallowed up by liabilities, and therefore such a business can fall out of the market. So there must be an enabling environment within which these businesses can easily swim into what we call a growing net asset position, or even increasing cash flows. So managerial economics can also be understood through the appreciation of economics of business. So if we want to manage our economy very well, and we are managerial economists, we've got to actually understand the economics of a business, because as a business is the smallest unit, is one of the small units that make up an economy, then it is very important to study how we run a business as part of the economy, or itself being an economy. So there are pertinent issues that we focus on to see that our firms or our company or organization is actually sustainable. And you remember that to have a sustainable organization, yes, you have started the organization. But starting an organization as an entrepreneur is good but not sufficient, because it is also important to start, oh yes, but more important to sustain. So we sustain what has been started by management. Entrepreneurship starts, then management sustains, and then innovation, creativity expands, and then we are able to see later that we are making more profits. Now later on you see that for you to sustain business, then these businesses, wherever we invest in them, we should actually receive the returns on investment. The returns on investment are usually computed as interests are made by investment of capital, and therefore when there is capital investment and capital inputs or any form of capitation of an institution, we have to make sure that the returns on investment are actually received. When returns on investments are not received, then that means that our investments are depleting, or they are actually constant or stagnated. So where we we invest and we have capital inputs, then we expect the returns on investment. There must be already a calculation of what we call the internal rate of return, and if we are to input finances into the business, we should know when to actually get the returns, when the payback period can be actually realized, when can the project, or when can actually our investment be able to yield back to us. So that also, the other element is to make sure that where we are making profits, we make sure that we make more profits to sustain our business. And making more profits does not necessarily mean increasing profit per unit item, but to increase the number of units, that's you increase the volumes of items from which the profit is charged, by making sure that there is more production and also there are more sales volumes made. You're selling more because you're producing more. So then you must make sure that the market is actually in acceptance of the product, and there is that loyalty that customers are having on the product that you're marketing. So the quality of the product will also determine the profitability. But also the other aspect is the aspect of quantity. Yes, a good quality product which is not sold in large quantities, then is also likely to create losses. So yes, managerial economics are making sure that the quality of the product is high and adequate, but also the quantity of items being sold should also be high. So the more items that are sold to the market and consumed in the market, the more profitability an organization can be. Actually, some organizations are working towards making sure that the profit per unit is very small, but the number of units sold has got to be very large. So sales volumes have got to be very large. So someone was asking how people who make these matches, the matchboxes, make money. So yes, when you look at the amount of money A person producing matchboxes earn from each of the each of the box, not the carton, from each of the piece of the piece that has the 40 matches is very small. Actually, the money is in 20 shillings, 0.0 dollars, so $0.01, but you find that these people are actually breaking even and are making profits. Why? Because they are looking at selling billions and millions of matchboxes, and if you are to multiply 20 shillings times 1 billion, then you will 1 billion matchboxes, then you will realize that they will be making 20 billion shillings on selling a billion matchboxes. So though they are making very little money on each unit, but if the focus is maintained on making sure that the sales volumes are larger, then the profits can be very large than making sure you increase the profitability on one matchbox and then you sell in hundreds. So when you, even if you sold a matchbox and you're making 50 shillings, for example, from a matchbox, and then you, instead of selling 1 billion, you sell 1 million matchboxes, that is 50 million. So the other one is making 20 billion, for you're making 50 million, because your sales volume is very small. So all entities that are actually making sure that there is profit maximization tend to focus on making sure that the sales volumes are large, but the profits made per unit is small. So the more the product is made affordable, the more the sales volumes in the market. To some products which are actually uh, 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 which are actually driven on the rims of low profitability, low gross profit, the higher the sales volume. However, that principle does not work for all items in the world. However, the statistics show that the more the price is affordable, then the more the sellability of the item. So you must make sure that even competition is monitored and studied, and also adjustments are made in the swiftest possible time, but strategically, to cope with competition and also overrange competition. So where competition is, there comes market sharing. And where market sharing is, if the company has not strategically positioned itself, then its market can be shared to the extent that the proportion that you're left with is so small that cannot actually result into sustainable business. So we are always making sure that organizations are almost fresh, and each time the organization is a new environment. Each time the way you run businesses, your business 5 years back may not still be the replication of what you should do today, and even what you should do in the nearby years. So every time there are new inventions, there are new strategies, new methods, new procedures and processes, new models, new outlooks, new fashions, and new tastes and preferences. So the business has got to have a cross watch, and they even have an innovative department which comes up with a newer setup of what should be done and how to handle customers, so that competition is overridden. Though we cannot exhaust overriding competition, we can still be in watch of competition and find strategies of overcoming it. Technology is another way of sustainable businesses To sustain business, creating technology and adopting technology is very key. So the more technological advancements you're using for swiftness and efficiency, and create also labeling to make sure that there is effectiveness using technology, computer resources, flow of information, flow of stock, and the monitoring of stock goods, monitoring production processes, and also making sure that it's automation of production using auto layouts and using machines to run assemblies and also in production is very key. So every time machines of more efficiency are being invented and they are being created, so capacities of machines have got to be examined each time, and also the quality of their outputs, and making sure that there is trained workforce to operate in the technological environment. So where manual labor is, then efficiency may struggle, but where automation is, then efficiency can be achieved. We can operate 24 hours and even operate more hours beyond just a single shift when we are using technology. To sustain business, again, you need to set ways of how you can attract customers. From attraction, there must be strategies to retain attracted customers. Retention of customers is very key. Organizations that are very effective do not only focus on how many customers have bought. Purchasing only is not sufficient to determine that you have a client base. However, although we can base on number of customers who have purchased to make decisions, we cannot conclude that that is sufficient. So we can also introduce another aspect of how many customers among those who are purchasing have actually returned to make an extra purchase or extra purchases. So the number of repeat customers will determine your growth in business in terms of client base. We not just make a single sale and conclude that we are now well off. A customer should either return or recommend another colleague or colleagues or even entire organizations to return to you. And thus the customer should reach at a time where he or she feels that you are the only person who has the potential of supplying to that individual or to the organization. That there are organizations that can have customers repeating to purchase for over 20, 50 years, and even these customers keep noting that if you are to purchase this or to get it, this is the brand. So organizations don't only conclude by making sure they make a sale, but to keep the relationship with the client and monitoring customer trends to see that the customer is satisfied each time, and more ways to satisfy the customer are discovered, and then they are also used to improve the product model, the product size, the product specifications, and also creating a variety of products and service lines that can result into customer satisfaction. So customers don't only get satisfied by buying a product, but also complementary services such as waiting time and the additional services such as helping the customer to understand the functionality and the usage of and the utilization of the product, and also handling customer inquiries and the customers' complaints, which may not necessarily mean the customer coming to buy, and also providing safety and security to customers, and the setting a conducive environment where the customer can easily interact with the service provider each time the customer has a need. So we also see that it is very important that all these factors, whether it is competition, technology, or customer relations, even monitoring the investments, so they are very, very important in contributing to sustainability of a business. So the business has got to undertake some stages. One of the stage is that which we call the cost plus, and then we have cost management, revenue management, and then revenue plus. So when we are talking about cost plus, and cost plus is always, when it is extended, it will result into cost management. So we have got to actually translate all the costs. When we manage our costs, then the other element is to make sure that we manage our revenue sources and make sure that our revenues keep growing. So when stage one, so the pressure from competition, for example, technology, customer force, and technology, these customers are forced to actually look for which organizations have the least possible prices, because customers are looking for where is the product which is more affordable. So this means that organizations have got to make sure that even if they are involved in production, their raw materials are of high quality but of low costs, of the most affordable costs. Organizations should also look towards making sure that the cost centers are defined, and also that each of the cost center is monitored to make sure that the costs are maintained within the minimum levels. So the lower the costs, then the higher is the possibility of having an affordable product. But when costs are not cut, or the organization chooses not to downsize, or to restructure, or to re-engineer ways of creating the most efficient way, efficient technologies, efficient machines, and then it is either employing many people unnecessarily, or its organization structure is so vast that it is itself another cost to handle, and also the processes are very costly, then cost management cannot be realized. So the biggest job here is to make sure that there is cost cutting. Cost cutting will draw us into making sure that our products are affordable, but also when they are affordable on the market, many customers will run for such a product. So that's why you'll find that there is a company that produces water, and when they measured the grammage of the weight, this is HDPE, it's called high density plastic. So the HDPE of a cup, this in bottles, when you look at a bottle of water, the density of a bottle cap is higher than the bottle itself. So these bottle caps were examined and they found that their density was very high, and therefore they demanded that they reduce on the density, the weight, even the weight. So because to reduce density, you have to reduce the mass per unit volume. So the density was too high that the cost of a cup was high. This company cut the weight of the cup and changed the mold, and the cost was cut by 7 shillings per cup. Just imagine, cutting the cost by 7 shillings per cup appears to be very small money, but that where the company was producing 1 million cups per day for packaging, that means that they had reduced the cost by 7 million per day. In reducing the cost of a cup by 7 shillings, the organization cut costs by 7 million per day. Now, just know if the effective production days are 20, that would translate to over 14 million per month if the production days are made 20. So that cost is very big. It can even pay for salaries of people. It is until we do cost analysis and the cost examination that we are able to see that there are certain aspects which we can downsize, and then we can refashion and come up with the lower costs. Some companies choose to outsource instead of insourcing, still to cut costs. Others decentralize production and then contract other subcontract producers to handle some parts to cut costs. Others, instead of uh, outsourcing, they choose to produce on site. All those, there should be a projection which you're basing on to say, if I produced locally, what would it be? And another costing framework should show, if I produced through outsourcing, then how can it also run? Then you make the decisions, because managerial economics is very key in actually making economic decisions within the business, so that we cut costs but also increase revenue. And then reducing costs and increasing revenue. So when the cost cutting gets to the climax, then with the other thing to pursue is that we call efficiency. Efficiency is counted in terms of time, production per unit time, or sales per unit time. So how efficient are we making sales? How efficient are we producing? Are we efficient? So there must be reducing high output, low, in the least possible time. Then the other element is to see that there must be growth. Growth is very key, because for us to determine that there is growth, there must be increasing productivity, which increasing productivity will tell us that there is increasing sales, and increasing sales would also mean increasing profitability. The more the sales, the more the gross profit. So the more the gross profit, and the more we also cut down our expenses, that is also costs and expenses, then the more we draw our organization to net profiting. The more net profiting, the more the organization grows in retained earnings, which are actually increasing assets. It is harder to increase the asset base of a company which is loss-making, because loss means reducing on assets. So when the company is in a loss-making position, and the problem of the company is with customers not consuming, then the company is in a critical problem, because the solution of an organization or any company is with increasing customer satisfaction and increasing sales to such customers who are getting satisfied. But when customers shun products and avoid them, and then marketing is done and all promotions are done and there is no response, then trying to capitalize this company can be a very risky environment. Otherwise, it may demand for a change of production line, or a complete dismantling of the organization, which we are calling a restructuring of the organization. You can restructure production, you can restructure human resource, you can restructure marketing, you can restructure finance handling, you can restructure every department, or even change the complete functionality of the organization. But where there is growing profitability, then the company we can say this organization is likely to uh, uh, to grow, because growth is in terms of increasing customers, increasing sales, increasing revenue, increasing loyalty, and increasing production. But remember that what we produce is the quantity produced is widely determined by the quantity demanded in the market. So the more demand for the product, the more we produce. But now where the opportunity is that when the demand exceeds production, then we can now capitalize easily our farm through sourcing for capital, or otherwise we can even go for a loan with assurance that the clients will buy, and then we are able to generate to repay the principal and the interest. So it is the best position to borrow cash when the organization is promising in the market that the demand is high, but the capital to finance or to support the production to satisfy the demand is not there. Then we can go borrow and produce, then sell, and then be able to repay. So then the other is now when stage 3 is completed, now now it becomes very essential to make sure that we respond to the changes, to change. So we can now respond to change, so that anything the client needs we can easily supply, and be able to remain afloat. So there are very important aspects here which we should note, and these are key concepts that you need to have. Economics is divided into two elements, into two major components. There is microeconomics and macroeconomics. So microeconomics actually deals with individual aspects. For example, at the individual business level, we can look at production in by producers and manufacturers. We can look at consumption by customers and in the market. We can also look at the firms themselves generally and the specific markets that are being served by the organization. So microeconomics is at individual business levels. So if you are to study this aspect of microeconomics, you actually study the economics of business. And then so some of the aspects there you look at, especially if it comes to consumption. Yes, the customers will first demand, then you supply. You supply from what you produce or what you have purchased if you are a trader. Then to supply to the market, the market, then that demand is the demand of the customer. And all the people who have a need about our product, we call them prospective customers. They prospect that these customers may buy because they have already expressed that they have a need, and also they have ability to pay. Then from that, then we can now start measuring how do we price our products basing on the raw material inputs, and also how much it costs us to produce, and then how much it costs us to deliver the product. So all through that, we start now to understand our cost structures for each of the individual goods or services, and now start to tag a price to each item produced, with the perspective that this item is entering a competitive market where the people demanding have a wider pool of related products to select from, or otherwise, even if they don't have a wider pool of related products, another producer and manufacturer is coming up with a better product to offer. And all those perspectives are maintained while pricing the product, packaging it, and also giving it specifications. Then the other aspect is the aspect of macroeconomics, which is a larger aspect of it, where we look at the totality or the aggregated economy. Aggregated economy means we come up and sum up all the production entities that are happening in the country, including those at individual, at group level, at company level, and those in very in multinational production organizations. So we sum up all of them. That's why we say macroeconomics is an extended way of looking at microeconomics. So when we look at the country or a region, we have to be able to examine what actually is happening and sum up what exactly people are handling in such a community, including primary producers, secondary producers, and tertiary producers, and then look at how they trade what they produce and how much do they earn from such production or of their goods, and then also the other side of services. So we here, when you look at this, we shall you assess the gross domestic product, which is a national income analysis. So gross domestic product, you're looking at what is the total of what is being produced in the country generally. And then we also look at unemployment, because these organizations which we are summing here as the national production of services and goods in gross domestic production, should be able to absorb all the labor. All the labor should be absorbed within the production here at GDP level. But if this production here in GDP is not able to absorb all the labor in the country, then the remaining or the surplus, we call it unemployment. So those people are out there in the communities, but they have the labor, they have the efforts, their skills, and the training is there, but they have nowhere to offer their services. So we call them to be unemployed. However, we also in macroeconomics look at aspects such as inflation, the inflationary changes in prices of goods, and these are actually general increases in prices of goods. And then we look at inflations, which is general. If it is one item, then we call it escalation, not necessarily inflation. So where inflation is, then the Bank of Uganda or the bank of a state bank or the central bank can use all the fiscal and monetary policy trying to regulate the inflation, so that the inflation is managed and confined and maintained within the bearable minimum. And it does it through the central banks do it through its monetary policy, where it manages the economy using principles of what you call the commercial bank rates. So it can use commercial bank rates, can use the currency values, it can do printing of currency, it can employ all other uh, um, monetary policies to try to arrest a situation where inflation is. And also other aspects such as trade, especially looking at exports and imports, and making sure that there are more exports of finished products and imports uh, of raw material, other than exporting raw materials and then importing finished goods. Why? Because when we export less value and then import goods of more value, the difference will be negative, because we see what we call balance of trade is the difference between exports and imports of a state. So if exports are lower, you're exporting less, take away the more imports, then it means that the company, the country is losing more money. More money is leaving the country than it is the country is attracting money, money or financial resources from other states. So that draws the company into a net drain, a net financial drain, which we call a negative balance of payment. So negative balance of payments are actually managed through regulating exports. So you'll find that exporting raw materials, you'll face a lot of taxes to discourage export of raw materials, where now the local farms, instead of exporting raw materials, change to say, let us now locally produce goods and export finished goods. So the countries are laboring to make sure that export of goods is good, but then you export finished goods. And import of finished goods, yes, would be good, but then if you continue to import finished goods, you'll be affecting the local producers and creating a lot of competition. So some of the countries are making sure that if they are imports, then imports are charged, especially for goods which are already uh, uh, produced locally. Similar goods produced locally, those imports are actually overcharged to discourage importing those goods, but again encourage locals to buy locally produced goods, so that you produce within and then export finished goods, other than importing finished goods and exporting raw materials. So that's where companies would really and the nations would really leverage an advantage of buying locally produced goods, but also nations have got to make sure that the standards, the national standards, are maintained, and that locally produced goods can actually compete on the international standards and international setups. If organizations or countries do not put up or adopt those international standards and national standards, then local farms are likely to produce goods which don't meet international standards, that even nationals can shun and avoid to consume products that are produced from within, and start opting to smuggle goods across borders, because the nationals would be demanding for what is should be imported, yet the tax body has set rates, tax rates higher to discourage import of such goods. So the job is to make sure that the standards are actually met, and also local farms are supported, and local investors are stimulated, and the incentives are provided, so that these local manufacturers, can actually swim in the manufacturing industry, and be able to break the international restrictions and international barriers of quality, and also international barriers to trade due to boundaries, issues of interstate boundaries and interstate borders. So what is being initiated now is the Africa free, the Africa Continental Free Trade Area, where we are saying let us trade without any restrictions. If we are African countries, then let us widen our market, so that we consume products which are produced from within, but the market is not very limited. So because the more customers, the more pool of customers, then the more production of goods to satisfy such a large pool of customers. So financial relations among nations are also very key, where flow of cash is not also restricted, and actually some countries are making sure that we have common currency, where there is a single currency that can work for example, African countries, such as just like you see a dollar working in all states of the United States. So where here we have to keep on exchanging cash. When you're trading with Kenya, you have to get to buy the Kenyan shilling. Then when you go to Tanzania, you've got to buy the Tanzanian shilling. If you go to to South Africa, then you have to buy the South African rands. All those have to we have to agree on the on the currency to adopt as African states. So here we also have the other concepts such as scarcity. So when we say scarcity, is a condition where resources are not available to satisfy all the needs and wants of the specific group of people. So when the resources are not sufficiently available, then we say there is a scarcity. Therefore, such resources have got to be tightly managed to make sure that they are able to to satisfy the needs of people. You either choose to satisfy needs or you choose to satisfy wants. But wants are broader. That's why we see some, or you start with first the needs, which are the basic requirements for life. If we want life to live, then possibly you need to have the primary requirements such as food, water, shelter, and the health of people should have something to drink, something to quench their hunger, somewhere to reside. They should have health services as primary, or what we call primary needs or basic needs. However, needs can also be expanded by what you saw as Abraham Maslow's hierarchy of needs, which starts from physiological needs to safety and security, and then you go to love and belonging, self-esteem, self-actualization, and then self-transcendence, as it has been extended by other scholars. However, here we note that it is very important to first see that the needs of the people are satisfied, and then therefore we can widen this to the wants, which are desires of people, and wants are different from needs. So wants are generally what people really desire, feel interested in, even if they are not wants, even if they are not needs, but if the person is interested in such an item, or is interested in having such a preferred service, even if it is not necessarily that if the person does not have such will die or will fail to live, but is essential for life, then we say that is a want. Then the other aspect is the aspect of demand and supply. And this concept of demand and supply, remember that demand is the customer demanding, or a prospective customer, and what we call demand is what creates a market. So producers of goods are making sure that even if the item is not known, at least when it is created, an explanation is made and the functionality, then the demonstration is made for a client to learn that that product is needed in life, and if it is survived, it can change life. So if you are to look at how a product is introduced into the market, then you will see that demand can also be created. Though customers can create their own demand, even manufacturers can create what the customers should demand. So the two, of course, people would not demand for smartphones until the smartphones were invented. It was not out of demand that the smartphones were created, but it was out of invention that someone created what people should demand. So it is a two-way. Customers can demand, but also suppliers can create what customers should demand. So markets are given by supply and the demand. So if you are to drive a market, then there must be forces of supply and demand. It is actually demand first, then supply next. That's why it is better now to change this to demand and supply. However, it is also possible to supply, then people demand, if the product has not yet been has not yet, if people have not yet learned that that product is essential, then you can first supply it to the market by making sure it is available, people test it, and people try it out, and afterwards they start demanding for what. Whereas the other thing we used last time, it worked for me, so bring more. So the two can also work interchangeably, though mostly it is demand first, then supply next. However, you can also supply, then demand. People demand later. So if we are to monitor prices, we can also be able to oscillate prices based on the demand and the supply forces. However, organizations are making sure that they are in control of the prices, so that it is prices are not changing anytime, and they cap the prices and only change prices in case the demand, there is a pressing need to actually create adjustments, which are usually due to inflationary changes and fluctuations in raw material, and also changes in taxes, changes in and changes in the localities. uh, uh, Places which are very far may end up getting higher prices due to logistical changes and changes in costs of delivery. Now you also see that the demand is defined as how much of a good or a service is desired by customers. So for example, if the price of an item like apple is low, then the people will purchase them more or demand them. So this means that customers will run uh, and line up for what they consider to be affordable, provided that is the quality that the customer wants. Then the customer will actually run towards that and would want to have it as an item to prefer. So organizations are also working towards making sure that they use the least possible costs to produce, to package, and to deliver. That's why you find that a water factory, it's instead of driving a few cartons, it is actually making sure that each route the vehicles are taking, they are actually packing the biggest volume to make sure that the cost of delivery per unit carton is lowered. And when that is done, then the customer will actually be uh, uh, receiving an affordable product. And then so that you don't have to keep changing the price of the item in each locality, that each district there is a new price of the item. Each district there is a new price of the item. So you would rather choose on the distribution system and the volumes of distributions, so that you increase volume of the volume of what you're distributing and reducing the cost per unit of an item you're actually distributing. So when that is managed, then the product will be affordable and people will continue with unfading demand, or with an increasing demand for the product. Where there is increasing demand for a product, then there is also increasing possibility of sustainability of supply of such a product. So if the price of the apple is high, for example, then only a few people will purchase such apples, and therefore they will consider that to be very expensive, and they can actually avoid to buy apples and find alternatives of items that they can actually buy other than lining up for apples. So on the other side of supply, so this is how much the market offers. So at a low price, then the supplier will produce less, and thus you see low revenue collected. And at a high price, the suppliers can produce more if that actually the customers are demanding for more. Yeah, then you produce more and supply more, and then the profits will be higher. But remember that by selling high priced goods at a high quantity, then the profitability is very high. But in the midst of competition, there must be a study made, because when you maintain high price and high quantities, that may not be very sustainable. The best thing is to make sure that you moderate the prices but increase the quantity of supplies, so that even when there is competition, the customers continue demanding for your product. Then you continue to supply to satisfy that demand. Then we shall look at this. These are some of the key elements we base on to see production is sustainable, initiated, but also sustainable, such as land, that you must have land which is physical location, but also, or it could be a location for production, but can also be a location for trade, or a showroom where you are located, where your premises are going to be. But we also have what we call virtual spaces. So natural, it could be natural, this is the natural physical land, but also a virtual space. We can also have a virtual space, and that virtual space can also be purchased. So when we have land, then we have a seat for all the natural resources. If you are to set up a building, that building can be sitting on land. And when you are working, you're working on land. So land here is very key in production, and therefore in managerial economics we see that these natural resources should be acquired, but also should be maintained, because at any time they are, as we use them, they are depreciating, though land depreciates at a very low rate. But other assets that are sitting on land, they are actually depreciating. So we have got to set strategies of maintaining and also rebuilding new ones, or acquiring new ones. Then we also have another factor called capital, which is actually initial money and investment monies, or even intellectual assets. If you don't have wisdom, which is also another aspect of capital, wisdom, understanding, and knowledge, then you struggle also, because capital is not only money, but also where there is money, you also need intellectual capital, which is wisdom, understanding, and knowledge. Otherwise, investments without wisdom, understanding, and knowledge, all those that money can be put to loss, and your investments may not be a careful investment. That's why many organizations that are sustainable, they first develop what we call a strategic plan, defining what should be done and how will it be done, what do we need, and then actually translate that into a business plan and an action plan. Then labor, and then these are workforces, so you need the labor, and this labor in the current generation, we are seeing that there is labor which is human labor, but also there is machine machine or digital labor, machine where robots can be used, or automated machines. So labor, here we can look at workforce, how many people, the size of labor, how many should we have, and what education background, and then what quality of work, and then the work ethics to be considered. So labor, then you pay salary, capital, you have interest, and land, Then you have you have entrepreneurship, making profit. And then so entrepreneurs, they have got to invent ways of what to be started, and then start up, and then take risks, but find ways of averting the risks, and the mitigating risks, so that business continues to be sustainable, and also continues to be progressive, to be progressing. So this is very key, and that's why you see that where we have land, labor, capital, entrepreneurship, which starts, then there must be sustainability through management. Then now we can set up an entity which is set up to satisfy the needs and the wants of people, and that population where you see needs and wants of people, that's where we are saying that is where the market is, the market. So to catch and to have a catchment in the market, then you must make sure that there is needs satisfaction, and also needs assessment. You can't satisfy the needs of people when you have not assessed their needs. So that's where you see resources, and then those resources are what will make you're using those resources and to produce items, which we said those are the items you're going to supply to the market, which market has needs. So these needs are the ones that are prompting the market to demand for the product. So as you offer the product, you're tagging it with price, and then also extending it to the client through distribution. So that's what you see there. So some producers have to ask questions here. For example, what do we produce? So what should we produce? How should we produce it? That's the process now. What to produce, you define the item, or that's the 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 service or the product. Then you have got to define its specifications, its quality. Then know then be able to know what will be the characteristics of this product. So usually they define the product and shape it up, and see that this product is actually what will satisfy the market, and how to produce it, then the resources needed, and then the process to be taken, and then afterwards the end product is put up. Then when the end product is put up, then a prototype is established and tested on the market. But this market you're testing, you're meaning these people whom we are saying here, another question, for whom to produce, because the shape on the design of the product is tailored towards the needs of the customers, and then the demand of the customers. So if you not define the target market and the specific the prospective market, the target market, and that market niche which you really want the product to address, there must be who is going to consume the product, and then how does he want the product to be, and then you make it better, exceeding that the customer actually expected. So there's meeting customer expectation, but there is also exceeding the customer's expectation. So bigger firms are actually working towards exceeding the customer's expectation, because customers' expectations can also be limited themselves. So we examine them by through a needs assessment, and also try to improve and go above those needs, that when the customer tests our product, uses our product, he says or she says that this is the only product I can ever have. So then we shall add on from here, I want to thank you for being here with us. My name is Wilber Ssebuyungo Kivekayunga. I'm the winner of the Male Champions Award, the most gender-focused African youth entrepreneur. So on the Continental Award, I won the Continental Award, raised in South Africa, in Cape Town, as the most gender-focused youth entrepreneur in Africa. And I really congratulate myself and thank God for that award. I've also won the awards for digitization in Africa as one of the digital agent and the most influential digital agent in Africa, where I won the digital award for digitization, and I've used the digital transition and transformation as a propelling agent for weaving digital policies and the use of artificial intelligence for effective business and education. I work with the Action Entrepreneurs and the Managing Director. I studied education of entrepreneurship and management, and also studied a master's in planning and management. Also studied a bachelor's of leading change in digital transition and green transformation. I also studied to manage businesses with an MBA, which MBA is in the University of Clark International University in Muyenga, Kampala. I would like to thank you for following up here. We do business planning and management, also do education and consultancy, also do international developments, specifically supporting the youth, but also in digitization and green transition. Those are the contacts. You can raise me on those contacts, or continue to relate with us, the Action Entrepreneurs, through those emails. We leave you to be a just, productive, and orderly people. Thank you for being with us. Have a nice time. We shall link up in our other tutorials. Have a nice day.